Hello, welcome. It's a property podcast. I'm Rob B with Rob D, and it's episode 310. The Fundamentals Roadshow carries on, and this week we're looking at the real reasons why property goes up in value. Now, understanding is pretty cool, but what's even better is using it to your advantage.
Yes, thank you for joining us again for the Property Podcast, where every Thursday morning property investors come together to be informed and inspired. This week we're looking at one of the most inspirational ideas of all, how property is going to generate some serious wealth for you over the long term. And as if that weren't enough, stick around to the end for Hub Extra, where we've got a book that's going to change your mindset about what is possible.
So quite a shocking headline this week, Rob. The headline reads, and this is from Sky News, your move owner to close 124 high street branches to boost profits. And your move have a number of different brands under their belts, but it's actually Reed Rains. Their Reed Rains chains, many people would be familiar with. They're shutting down 124 branches, which is huge. Overall, the amount of branches is going down from 404 to 280. That's quite staggering. That's not like, let's do this slowly. They've made a big cut there. But the thing that really stuck out for me, Rob, the new strategy is aimed to ensure profits of at least £80,000 per branch. That sounds like they're being aspirational. Like, if £80,000 per branch is an aspirational target, then I think the death of the high street agent is going to be sooner than we possibly thought.
Yeah, and credit to you, Rob. This is something that you've been predicting for a long time, saying that high street agency is going to be a thing of the past. And it's not a thing of the past yet. Of course, this is only one chain cutting its numbers, but it's a big chain. It's a big cut. And this could well be the first of more to come. I'm sure all their competitors will be keeping an eye on this to see how it goes. But it does feel somewhat inevitable. And there are so many challenges at the moment. So in the sales market, there's the fact that transactions have slowed down so much for various reasons at the moment. In lettings, they're about to lose tenant fees, which especially in the southeast can be absolutely massive. So there are all these pressures. You can see why they're doing it now. It'll be really interesting to see if this is a success for them and if others follow suit.
Yeah, it's going to be really interesting to see how this plays out, but I'm still firm on the prediction that high street agents will be very much like travel agents. Travel agents used to be everywhere on the high street, and now there's only a couple of brands left and just independent specialists. And I think that's where estate agents need to go. They need to find their niche. They need to find a reason to stand out, because just playing out the same strategy of 10, 20 years ago isn't going to work.
Okay, time now for a very important announcement, one that we've been waiting to make for a while, which is that Property Hub meetups are returning. We've had a couple of months off and we've had a lot of people asking what's going on because they were super duper popular. But the reason that they went away was so we could give them a complete overhaul. We had lots of people going along and having a great time and saying wonderful things about the meetups, but we knew that they could be even better. So we spoke to a lot of people, got a lot of really great feedback, and we've come back with a format that we think is going to make them even more valuable for you. So we've got new and better venues, so it's going to be quieter and you'll have a far better experience. And we've put a new format in place and limited the number of attendees, which means that rather than turning up and having loads of people and you don't really know who to talk to, it's going to be far easier for you to identify the people who you're going to have the best conversations with and get what you need out of it. Because it's a social thing, yep, and that is really important because property investing can be lonely, but it's about somewhere to go to find out about the local area, to gather information, to learn from people who are a little bit ahead of you maybe. That's what makes Property Hub meetups so great. It's not somewhere that you go to get sold to or to kid yourself that you're doing something positive that's going to help you. It's somewhere that you go to meet like-minded people and have conversations and develop relationships that really move your property investing forward. Now, in order to do this, we have introduced a small charge. Tickets now cost £5, so not a lot. We're not going to be getting rich off this. We're actually going to lose money on it. But we needed to introduce a small charge to allow us to have these better venues and to make sure that everyone turns up is serious and not there to just try and sell you something. So as before, meetups are going to be on the first Thursday of every single month, starting on Thursday, the 7th of March. To find your nearest and book your place, just get over to propertyhub.net/events. So today is our third instalment of our Fundamentals February series. If you are new to property, you do very well to make these the first episodes you listen to because these are the core concepts. And if you're more experienced, still so much value in going back to first principles and reminding yourself of what it is that underlies all this, that really drives property investment as a whole. We've covered leverage, we've covered inflation, and today we're covering something equally fundamental, which is why property goes up in value. Because most people assume that property tends to go up in value. They've seen it happen in the past. Most people also know that property doesn't go up in value by the same amount every year or at all every year. Sometimes it goes up a lot, sometimes it goes up not much, sometimes it falls. Why is that the case? If you don't really analyse it and you think that it just happens, property goes up sometimes, down sometimes, who knows why that's the case? Changes in price are just random. Then it makes it very difficult to invest intelligently and with confidence because you have no idea what's going to happen from one year to the next and no idea what's really going to happen over the long term. So let's put that right, because by the end of this episode, you're going to know the 3 factors that influence house prices, why the long-term direction is always up, and most importantly, how you can use this knowledge to your advantage. But first, Rob, we need to set the scene for this and talk about how property prices move over the long term with a quick recap of one of our very favourite subjects.
Yes, we are talking about the property cycle. Pretty much everyone knows that property prices go up over the long term, because you'll hear about people who bought their homes 40 years ago for about 10 pence and now they're worth millions. I'm exaggerating, but you hear all the stories of people who bought years and years ago and how much they're worth today. We now know that some of that is inflation, and if you've not listened to last week's episode, please go back and do so. But it doesn't go up consistently. There's not just a steady trend of property prices. It's not steady growth and nice and predictable. We sometimes get steady growth, but there's periods in a cycle where there's rapid growth and also crashes. So it looks random at first, but if you go back through history, and even 200 years worth of history, there are patterns here. And amazingly, the patterns are regular patterns, so much so that we're able to use them to be able to predict what's going to happen. So the first phase we have is the recovery phase. This tends to last for about 7 years, and this actually is the slow and steady growth part of the cycle. Not too exciting, not too many headlines, but property ticks up nicely. Nobody's getting carried away. Nobody thinks this is get rich time, but people are feeling reasonably pleasant about property. But then comes a mid-cycle wobble. It was too good to be true. The market's in trouble again. Well, it seems like that because the media will drive that negative story home. But actually, it's a mid-cycle wobble that doesn't last too long, which is actually made to seem far worse by the media than it actually is. Because what happens is after that wobble, we kick on, and we actually then go into an explosive phase where capital values really do rise, and they rise quite aggressively in periods, and everyone starts to get very, very excited about property. And this could be a fantastic time to invest as long as you're not right at the end of that period, because next up is a crash. Yeah, we've had a bit of growth, we had a bit of a wobble, we had that great period where everyone was making money, but then a crash comes, a correction. And property prices come down, and that is quickly followed by a recession phase that can last for up to 4 years. But don't worry, we kick on again and get back into that recovery phase, and so on. And it's important to note that the beginning of each cycle, the prices are higher than the last. So that's why we have that long-term trend. But Rob, those phases have a name.
Yes, this is what's known as the 18-year property cycle, and it's called that because it's a cycle, and on average, it lasts for 18 years. That's how long it takes for these 4 phases to all play out. Now, that is just an average over the last couple of 100 years. It can be less, it can be more. It's not worth getting too hung up on how long exactly it's going to last. The important thing is the order that these phases go in. The explosive phase could last for 2 years or 4 years or 6 years, but it's always followed by that crash, and then it starts all over again. And as Rob said, the really, really important thing is that each cycle always starts from a higher level, so the long-term trend is up. Otherwise, property would never go up in value over the long term because it would keep resetting to the same point. But that's not what happens. Now, this is a really important concept. We've covered it on the podcast before, but the best way to learn about the 18-year cycle, if you're not familiar with it already, is to go and check out the course on Property Hub University. Of course, it's completely free. All you need to do is go to propertyhub.net/university. So that's the long-term pattern, and we're going to come back to the long term. But in order to understand why prices go up over the long term, we need to understand what it is that drives property prices. Why do property prices move at all? Why don't they just stay the same all the time? Well, there are multiple different factors, but there are 3 main drivers that you need to understand that lie behind property prices. And the first of those is the one that you'd probably come up with if someone asked you why property prices go up, and that is supply and demand.
Yeah, this is the obvious one. If there's more demand than there is supply, prices go up. That happens with any goods or service. In the UK, famously, there haven't been enough houses built to keep up with demand. And we are falling behind year after year. Often we're not hitting half the quota needed in a single year. And if we miss it every year, the problem is only compounding. Now, there's reasons for this. The planning system definitely limits supply. We're also a small island, so there's only so much space. And with increasing demand because of a growing population and smaller average household sizes, so the amount of people who live in a property now is less than it was before, this explains why we have a supply and demand issue. And it also explains regional price changes, because prices in London have gone up a lot over the last 10 years because there's been so much demand. It's where a lot of jobs are, and supply growth has been limited. There's a finite amount of land you can build on in London. There are also some parts of the country where property prices are lower than a decade ago, and that's because demand has fallen, and the lack of jobs mean people have moved away. Now, supply and demand is the reason why property prices go up over the long term. And if it was just based on supply and demand, the property cycle probably wouldn't exist. It would probably be just steady, consistent growth, not too volatile. But there are two shorter term factors that really influence property prices more aggressively in terms of pushing them up, but also bringing them down. And the first of those is credit.
Yeah, credit, and that's mortgages to you and me, is essential to the housing market. And it plays a really big role. I don't think people think about this enough when they're thinking about why house prices are doing what they're doing. Think back to the credit crunch. Prices fell immediately after the crunch, and they largely fell because credit dried up. People couldn't get mortgages. Borrowing, if you could get a mortgage, wasn't actually more expensive, but most people couldn't get loans. Banks did not like lending against property. They're being very cautious. Therefore, not a lot of credit around. Therefore, not so many buyers, because most people use mortgages when they're buying property. The availability and the price of credit especially is also important because it determines the cost of renting versus buying. So if borrowing is really cheap, then buying your home as an owner-occupier is going to be cheap compared to renting. And as a result, people will be more likely to buy if they can. That, of course, creates more demand. That demand pushes up the price of housing up until the point when owning and renting cost roughly the same amount again. So that's an example of how the supply and demand factor and the credit factor interact with each other. And credit's also important from the point of view of an investor rather than an owner-occupier. When borrowing becomes cheaper, as an investor, you can afford to pay more for a property and still make the same percentage return. So cheaper credit supports higher house prices. So everyone knows about supply and demand, but credit is a very important driver of prices that gets ignored. And the same goes for the third factor, and that is sentiment.
Yes, sentiment, or put simply, how people are feeling. Because this is a short-term factor. Whatever the long-term patterns are, excessive positivity or negativity will influence what people do at any given time. Now, it makes sense that an investor is more likely to pay for a property if they have expectations that property prices will go up. And an owner-occupier is more likely to stretch themselves if they think the market is on an upward trend and they feel pretty good about the property market. But if it looks like prices might fall, or people are feeling generally negative about the economy in general, people hold off from buying, and the market can stall or even start falling. And if the market is falling, sellers tend to hold off even more, and that can compound the problem, because people hate the thought of making a loss, even though it's a paper loss, and the property they probably will go on to buy has fallen as well. Now, most people don't care about the long term, and that's why sentiment is so important. It's what's happening now that determines whether people are feeling bullish about a market or quite negative. And these three factors combined, supply and demand, credit and sentiment, are all in play at the same time. There's never one that's not influencing the market. And because of that, and it can be difficult to understand what affects property prices and the ability to predict what happens next. Because for most people, it's not a simple, predictable mechanism. But if you understand the longer term trends, it does become easier.
Yeah, if you understand the property cycle, then you can not be completely sure what's coming around the corner, and you can't time it exactly, but you can have a lot more confidence in what's going to happen. But what happens if you throw out the property cycle? You don't care what happens in the next 2 years. You don't even care what happens in the next 5 years or 10 years. What if you're buying with a 20, 30, 40-year time horizon? In that case, ignoring what happens from 1 year to the next, why is the long-term trend in property prices always up? Well as supply and demand in general, it comes back to rents. Rents are what drive the whole thing, because rents are what you have to pay if you don't own your property, and they're your income stream if you're an investor in property. And rents are determined by wages. It makes sense. People can only pay in proportion to how much they're making. You can try to charge whatever rent you like, but if people are earning that much, they're not going to be able to pay it. So in the long term, rents can only go up if wages go up. And wages do go up over the long term. They go up for two reasons. They go up because of inflation, which we talked about last week, and they go up because of productivity gains. Because over time, innovation occurs and it's possible to make a greater quantity of stuff with less effort. And some of those gains go to the people who produce them in the form of higher wages. So when wages go up, that means that rents can go up as well. And when rents go up, it means that both owner-occupiers and investors will be willing and able to pay more for a property than they did before. Because for an owner-occupier, it becomes relatively cheaper to buy. And for an investor, it means that you'll make a higher return on your investment because you're paying the same amount for the property, but you're able to charge more in rent. So that means that both groups are willing to pay more for a property than they were before. That means that sellers sense this and raise their prices, and they raise their prices until the rate of return goes back to where it was before. Again, this doesn't happen year to year, but this is what happens over the long term. So I think that this is one of the most reassuring things that you can possibly understand as a property investor. Because as long as you believe that inflation will continue to exist, and that humans will find better and more efficient ways of producing what people want, and that's productivity, the productivity that drives wage growth, then you can be confident that long-term prices will increase. Now, of course, those things might not happen, but I'd say that the majority of people will be relatively confident that over the long term, that's what's going to happen. And of course, in the UK specifically, it does help that there's lots of demand for housing because we've got an increasing population and smaller household sizes, like we've already said, and we've got those supply constraints that we've already talked about. There's only so much space and the planning system holds supply down. Once you layer that on top, you've really got a recipe for long-term price growth.
So what can you do with this knowledge? Well, let's start with the basics. First of all, you can feel confident in property as a long-term investment because you now know why these things are happening. If prices aren't growing, you can assess why. Is it to do with sentiment or credit? It certainly doesn't mean that property has suddenly become a bad long-term investment. You know that prices aren't randomly going to stop growing over the long term. You need a specific set of factors to change. More supply than demand, wages not growing, and inflation not existing. And realistically, that change isn't going to happen. So that's the basics. But if you want to go a little bit more advanced with this, you can apply this on a micro level to determine where to invest. So in the short term, you want to find an area where there's potential for above average price growth. What you need to look for is rents not being too stretched in relation to incomes, potential for local wage growth, and factors that might increase demand relative to supply, such as infrastructure and new employers going into an area. For reasons we've already seen, these factors will push up both rents and prices that owner-occupiers are willing to pay, and they'll also attract more investors into the market, putting further pressure on prices.
And once you understand that, it explains a lot of the patterns that we've seen in different parts of the country over the last little while. So it explains why London was performing better than any other area. Then it dropped to becoming the worst performing area in terms of price growth. It's because it reached a point where expectations couldn't be any more bullish. Sentiment couldn't have been any better. Rents were stretched in relation to incomes. They couldn't go up anymore. And demand, in terms of new people moving into the city, had peaked. Once that had happened, there was only one way that price growth could go. It also explains why yields are high in areas like the northeast of England, but we're not yet too excited about investing there. At the moment, there's not enough demand because not enough jobs are being created in that area. For that reason, wages are unlikely to rise much faster than inflation, and sentiment, the way people feel about prices in that region, are weak. So yields are high, and if that's why you're investing, that's great. But if you're investing for long-term capital appreciation, at the moment, that's not the place to be looking. It also explains why we're so bullish on the Northwest. We haven't just randomly picked Liverpool and Manchester and cities like that to get behind. There's a reason. It's because rents are low compared to incomes. Those incomes are growing and jobs, lots of jobs, are being created. And because those jobs are being created, because of the infrastructure that's going in and all the inward investment, there's a non-stop stream of good news. You never stop hearing positive news about the Northwest at the moment. And for that reason, sentiment is strong. And as we've heard, that drives prices upwards as well.
So if you come back and listen to this episode in 5 years' time, what's happening in those specific areas will probably have completely changed. But the fundamental economics won't have done. And that's what's really important here. So you can use the same logic to decide where the best place to invest is at any given time. So if you are listening to this in the future, you may think, oh, I've missed the boat on those areas. That may be the case. However, just take these principles, apply them to different areas, and you'll be able to use the same tools and strategies to be successful over the short term. But remember, even if you get it wrong, the long-term trends will look after you. And that's why it's so powerful to understand the fundamentals. Because if you understand the fundamentals of property, you become a lot more confident as an investor. So it's that time of the show where we thank a wonderful hubber for their thanks and praise. And this week is no different. A huge thank you to Tom. Tom's in his early 20s, and this feedback is incredible of the journey he's already gone on as a property investor. He writes, I can't find the property podcast enough for the continued free content and motivation. I didn't think it was possible, and I often hear people struggling to make that first step. I think what got me was the constant reminder of just going for it. I've just completed my first renovation and done my first property purchase. After moving out from my parents, the aim is to save and purchase a house and then save again for my property development. I've just refinanced a property I bought at $58,000 at $85,000. And now I have my residential home and my money in the bag for the next deal. Anyone in their early 20s that wants motivation, send them my way. Thanks again, Rob and Rob, Tom. Well, thank you, Tom. As we say so often, when we hear people taking action, it is so satisfying. It's great that the knowledge has helped, but it's the action that's the important bit. So congratulations to you. That's incredible feedback. Well done.
Well, I've absolutely loved this episode. We've had one of the most important, most fundamental topics there is to really remind you why property is such a fantastic investment. And then we've heard from someone who's done it to really show you that other people are achieving this. It can be done. But the episode isn't over yet because it's Hub Extra time. This is where we give you that little bit more in the form of a quote, a resource, an idea, something beyond property that's going to enrich your life. And this week we've got a book. It's a book I've just finished. It's by David Goggins and it's called Can't Hurt Me, Master Your Mind and Defy the Odds. Now, whatever challenges you think you've got in your life, let me tell you, it's nothing compared to this guy. The author of this book had pretty much the worst childhood and upbringing you could possibly imagine. It sounds truly, truly awful. And this book is about how he overcame all that to become a Navy SEAL and one of the world's top endurance athletes. It's a great book because it's such an amazing story. You wouldn't think it was real. This is surely got to be made into a movie one day because the progression of what a terrible, terrible place he started in and what unbelievable things he achieved, it just feels like pure Hollywood, but it's true. So it's a great story, but he also talks about the mental practices that he developed that allowed him to do it. If I were to sum it up, I'd say that the gist is he basically believes that everyone's too comfortable. Everyone's capable of doing far more than they believe they can. But to do that, you can't be comfortable. You have to seek out unpleasant experiences. You have to do things that are not fun because that's how you develop the mental discipline to do what needs to be done and to really push yourself beyond what you think you're capable of. So it's a great book, great story, powerful lessons. You'll probably feel a lot less pleased with yourself for your own achievements after reading what he's done by comparison, but well worth checking out all the same.
So that's our third instalment of Fundamentals February done. We've got our final instalment next week, which is an important one because it's all about you. And it's what type of investor are you? Because you really need to understand yourself as an investor to make sure you're doing things the right way. Now, you may have been investing for years, but if you haven't really analysed yourself as an investor and understand who you are, you might be making wrong decisions. Or you might be making the right decisions, but don't know. So next week will allow you to validate that. And if you're new to property, well, it's going to be a cracker because you're going to be more efficient and a better investor from the get-go. So make sure you join us for that. And make sure you join us on Tuesday for Ask Rob and Rob. But in the meantime, take care, have fun. Bye-bye.
Bye-bye.